What is the difference between debt and equity financing?
Well, there's probably, if you think about it, it's a little more traditional than what you think. So debt equity or debt financing is a company's use of banks, loans, private lenders, and think about it as being more similar to installment loans, loans in general that require payment on a certain fixed term. Some of these instruments can be where it's not monthly payments back; it can be balloon payments. There's a lot of different structures of different type of debt instruments that can work for your company, uh, and they offer some benefit also. They also offer a benefit that you don't have another owner coming in. You don't have to bring them on the board. They don't have to have decision making. You don't owe them a fiduciary duty per se, or at least just to remain solvent. Otherwise, you don't, or not to use the money improperly. But it also comes with a requirement that you have to make certain payments, which is sometimes hard with startup companies because cash flow is usually very tight and not forthcoming until after a lot of development, um, and launching in the market the product has actually happened. So often that's not really helpful for startups, but it is a solution not to have someone take over part of your company. Equity financing is basically using the equity in your company to raise money for operational needs, for marketing needs, development needs, and the person in exchange is getting equity. It's getting shares in the company, and that's also good in the sense that you have someone that might be interested in seeing the company do well enough where they think they want to actually invest in the company. They believe in it enough to do so. You can also use equity financing for sweat equity purposes, for attracting talent, management, and investors. But often remember when you're going to do this, a lot of times your company has to have certain operating agreements, certain structures in place. Depending on how much money the person gives you for equity, they may also require a seat on major decisions. They may require a seat at the board. They may limit what the company can do absent their approval, which could even include seeking additional equity financing. So, as the proverbial saying is, as the more strings attached to it, but there's more flexibility in that you don't have to pay it back. You don't have to worry about having to have operating or cash flow to be able to pay it back. Um, and there's a combination of them too, also. Sometimes you have convertibles that turn into equity. There's many different things you can have, but it's really up to the particular company and where they're at and how much control they want to give up or their objectives overall, whether short term or long term, as to whether to use debt or equity financing. Often I find companies might use a little bit of both. So it really depends what's best for you.
Thanks, Regina.
You're welcome.